Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 269th VideoCast podcast for the week ending December 12th, 2024, live from California for the first time ever. Very excited to be with you here. We're going to do family first, get right down to business. This is Annabelle. This just happened today. She dropped 13 seconds in her 500 free, which she is a sprinter, so this is a distance event. Dropped 13 seconds, went 5:33 to win the Rose Bowl Winter Championship for 10 and under. She's now ranked number 2 in the nation for 500 free. That is something that was not on the bingo card, so great job, Annabelle. There's Annabelle and Mimi. They had their event tournament last weekend, and Mimi had a rocket goal, and Annabelle's 12 and under team had no subs and played 3 straight games and won every single one. Very exciting there. And then we've got, hold on for a second here. This is us walking to the beach and having lunch. Pretty awesome stuff there. This is Jeff Adams with me at the Money Show Symposium. Jeff's a student at FSU doing a lot of admin work for me, some junior analyst work for me. Put the slideshow presentation together, did some write-up, so he's just doing an incredible job. Great job there, Jeff, and actually videotaped the whole thing for us as well. That was a dinner with Scott Walker down in Sarasota, compliments of Kim Gittler and co. at the Money Show. Very grateful for that. That's on Pacific Coast Highway, not far from our house. And pretty exciting stuff on that front. These are the pictures I left out last weekend. And this is from our Connecticut house. That's my mom with Mimi and Annabelle at Thanksgiving. And that's me and my mom at the restaurant we went to for Thanksgiving. Pretty exciting. And then finally, we'll just quickly do the 2 goals here at 1 second each. And here's the first one. This is Mimi. Look how calm. She's just chilling, waiting, picking her spots. Boom. All right, so that was pretty exciting. And then this one is Annabelle. Just got to... There's Annabelle right there. Boom. All right, so pretty exciting stuff. On to business, ladies and gentlemen. Had the pleasure to join Cheryl Casoni on the Clayman Countdown Fox Business this week on Tuesday. Want to thank Catherine Myers, Jake, Max, Stu, Oppenheimer, Brooke Haliskak, who produced this segment, and Liz Clayman for having me on. We're going to listen in here.
You know, and one of the things that you talk about in your research is fiscal and policy wildcards. And Tom, I want to take that to you because looking ahead to 2025, you know, you're saying these are possible surprises. The U.S. dollar could weaken after the inauguration and that energy stocks could underperform, which I think is interesting. And I want to point this out to you. Wolf Research put out a note this morning. They say that the Trump trade is already running out of steam. They say uncertainty in the first half puts a damper on that trade. So in the meantime, they're focused on the Mag 7. How do you respond to that?
Well, thanks, Cheryl. I think to tag on what Dutch was talking about, his long duration trades, I think the biggest surprise of 2025 is going to be that the 10-year Treasury gets bid, yields compress. What we saw in 2016, after the election, Treasuries sold off, yields went up. After the inauguration of Trump, bonds got bid, yields compressed, and that's going to help Dutch's long duration trades. But we like simpler stocks. We like Boeing is a headline today. That one's still down 60%, and you can't give it away. But guess what? Kelly Ortberg is fixing the ship. He's got the union problem solved. He's got the 737 back on the line. He's got a $500 billion backlog over the next 10 years. So I think it's going to surprise people that Boeing continues to climb higher.
But the concern about Boeing, though, is that about, I think it's, correct me if I'm wrong, about 60% of the revenue, the payment for each plane doesn't come into the company until they actually deliver the aircraft. So that all of this delay has been one of the issues that hit the stock during the strike. You're not concerned about this backlog?
They've taken out a tremendous amount of cost, Cheryl. The backlog is solid. China is going to double its fleet by 2043. Oh, and by the way, you can only get planes from two vendors. One's called Boeing, one's called Airbus. The stock's down 60%. This is one you can tuck away. You can sleep well at night. And by the way, Kelly Ortberg is a turnaround specialist. At Rockwell Collins, in just 6 years, he quadrupled the shareholders' money before he sold the company. So I think he's going to do a tremendous job turning things around. He's on the floor in Seattle. Engineer, not a salesperson. We're going to see good things from Boeing in the next 2 years.
And you can see from the chart, Tom, that the stock is in recovery mode, as to be expected after that strike ended. And Dutch, I want to go back to you again, talk about that fiscal policy question mark, as we are now, 40 days away from Inauguration Day. You're talking about those fiscal and policy wild cards, Dutch. I do want to get your take on, on federal deficits and stimulus, because, Biden is throwing out more student debt payments. He made that announcement today. So there's more fiscal stimulus going in, more cost to taxpayers. On the other side, you've got Elon Musk and Vivek Ramaswamy, and they're focused on $2 trillion in cuts and getting the fiscal house in Washington in order. How do you play that, though, as an investor as we wait?
I would say that, you got to get long this market. Okay, the Trump trade running out of steam, that's total garbage. It hadn't even started yet. Look at this dream team that he's put together. What happens if we cut government spending, rates come down, and he's able to lower the tax rates for individuals to next to nothing? This economy, the United States will become the most dominant player like ever on the planet that we've ever seen if they just let them do this. People will invest money in the markets. They will invest in people. They will grow their inventories. They will grow their businesses again. We're just getting started.
All right. Well, we shall see. I mean, certainly there's a lot of excitement around, in particular, in my mind, especially with dealing with nearly $36 trillion in debt that this nation is sitting on. Can we right the ship? And Dutch, you're saying that we can, and that would be great for the markets, obviously. Dutch Masters, Thomas Hayes, guys, thank you so much. It's great to see you both today. Appreciate your time.
And we're back. And there we go, ladies and gentlemen. Boeing is taking off. Pun intended. We've been pounding the table, loading the boat. That's one of our largest positions, just beginning, and I explained why. Then we had the Money Show appearance in Sarasota. This was really incredible. This was with Kim. I want to thank Kim Gittler, Debbie Osborne, Mike Larson, and Aaron West for having me. We're going to play this 30-second segment now.
Investment ideas. It doesn't, a lot of people will talk about their picks, but his research really goes in depth, really tells you the why, what catalysts are for the turnarounds that he identifies and so on. So I think you're going to enjoy his presentation. Again, hedge fund tips with Tom Hayes. You've seen him on Fox Business. You've seen him on podcasts, not just my own, but his. And he specializes, again, in finding those undervalued names that have a catalyst, or multiple catalysts that can help with the revaluation, that really sort of the Warren Buffett approach to buying undervalued companies. So please give a very warm welcome to Tom Hayes of Great Hope Capital.
So, good morning, everyone. Good morning. Okay. Has everyone had a great week here? A lot of value? Yeah. We really want to give a hand to Mike, to Debbie, to Kim, to Aaron, all the people that put this together, because without them, this wouldn't happen. So let's give them a hand. So, Brian Belsky talked a little bit about Jesus when he opened. And a lot of people, when they look to make the right decision, they say, what would Jesus do? I, on the other hand, when I look to make the right decision, I say, what would Warren Buffett do? And that's my framework. Hands up who thinks Warren Buffett is the greatest investor to ever live. I agree. And what we've heard a lot this week is about a lot of stocks and a lot of opportunities that have gone up a lot already, okay? And many of those will continue to go up. There's a momentum type of investor, and there's a mean reversion type of investor. I'm in the latter camp. I like to buy opportunities when they're on sale. I say Wall Street is the only place in the world when they throw a clearance sale, everyone runs out of the store versus into the store. So we're going to talk about a few bargains. And buying bargains is not for the faint of heart, but if you do accurate analysis and in-depth analysis, you can get tremendous returns over time with patience, with low leverage, and following a sensible, repeatable framework. So, a little bit about my background, why you should listen to me or not listen to me. I've been doing this for a long time, 1.5 decades in the hedge fund business, predominantly concentrated equity longs. We do tactical shorts from time to time when we think the market is overvalued, or a sector is overvalued, or a stock is overvalued, or we just want to dampen volatility and we don't want to create tax events for our clients. Maybe you see me on Fox Business, I do CNBC International, I do Yahoo Finance, etc. And hands up who saw the movie The Big Short. Well, prior to starting my own firm, I worked for Brad Pitt, okay? In that movie, his name was Ben Rickett in the movie, Ben Hockett in real life, one of the smartest guys I've ever met. Phenomenal experience at Cornwall Capital, some of the smartest guys in the room. They focus on asymmetric bets. I can say he's not quite as handsome in person, but he's much smarter than Brad Pitt for sure. And prior to that, I was at Bedford Oak Advisors, Value Shop. The principal was friends with Buffett for 40 years, so I had the privilege and blessing to travel to Omaha every single year. Some years on Gabelli's private jet, which was unbelievable for a young 30-something-year-old who grew up in New Jersey carrying golf bags at the golf course in the summer, and Columbia University. So that's some background. Now, we've covered that. We've developed a reputation over time of benefiting from sector, stock, and general market dislocations and periods of distress. That's kind of our knitting. I got the nickname Turnaround Tom because of that. The people that have followed me for a long time, the people who know me in the industry, know I like to run in when people are running out of the crowded movie theater and see how many purses were left on the chairs. And those are the opportunities to take advantage of. As Mike said, we have hedgefundtips.com. We post our weekly podcast there. It's called Hedge Fund Tips with Tom Hayes, very hard to remember. It has toggled between the 1 and 2 spot in the hedge fund category for podcasts. It's been going for 5 years, 268 episodes. And what's actually happened by mistake is all of our clients have come in through listening to that podcast. And the phone calls that I get are, I've been listening to you for 3 months, I've been listening to you for 6 months, I've been listening to you for a year, I've been listening to you for 2 years, I made a ton of money off your ideas, I'm gonna send you that money to manage because I'm running a business, I'm running a real estate company, I have a career, and et cetera. So that's how we do that. And we make our money buying on weakness and selling on strength. I know that's unpopular nowadays. People like to buy things that are strong and hope that they get stronger, and that's a strategy. It's just 2 different types of strategies. Mean reversion is what we do. Momentum, counting on inertia is what a lot of other people do. And our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk has actually come out of the asset versus gone in. You know, how many people feel like when a stock is falling, oh, that's risky, I better not get in? If the framework is correct and it's a cash generative company, or God forbid, the free cash flow is actually growing before the turnaround, you're actually getting less risk as the price comes down, and you can build a position over time. Most participants see volatility as increased risk. We view it as increased opportunities. So while many people look at the 52-week high list for opportunities, we look at the 52-week low list. That's not our core place, but we always want to pay attention to what sectors are down right now. Why are they down? Do they deserve to be down? You know, there are a lot of things that are cheap for a reason, and you don't want to get caught in that trap either. And that's kind of the special sauce of doing it for so many years. You start to figure out, okay, that sector, no matter what happens, you know, a lot of the commodity stocks, no matter what happens to the commodity, they figure out how to lose money all day long. A lot of the mining stocks, et cetera. And this is kind of the ethos of our firm and our philosophy. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. So some of you want to know where the market's going next. That's kind of not what we really do, but we did want to put a couple slides up. This shows the Dow Jones Industrial Average by year of the decade since 1897, so 120 years of data. And what we see on average is, like we saw in 2022, that was a down year. The second year of the decade tends, on average, is down, and you get some recovery in year 3 and 4, like we've seen in the last 2 years. And the middle part of the decade has a tendency to be strong. Now, if you look at this and say, oh, then I'm going to go all in, we've just had this. No, but you start to say to yourself, you look at the presidential cycle, it tends to be the midterm elections, you get a little weakness. So I think Jeff Hirsch said it well yesterday. He doesn't expect any type of material weakness until 2026. I think we probably get a little bit of a pullback after the inauguration. If past is any prologue, people are going to want to hold their stocks till through the end of the year. But earnings are good, and Belsky said double-digit earnings growth, double-digit stock markets. I think our base case for next year is somewhere between high single digits, maybe 6, 7, 8, 9% for the S&P, to potentially low double digits, 12% is our base case, which implies you'll have your 5 and 10% normal pullbacks, maybe in the early part of the year. Generally, after new president gets in, you get the rally into the inauguration, and then you get the first 4 to 6 months weak. That'll just be a time to find opportunity. Big picture here, this just shows long-term bull markets. This is a slide from Robert Slumer over at RBC, and it shows you, for the last 100 some odd years, you have 18 to 20 years of consolidation, followed by 18 to 20 years of expansion, 18 to 20 years of consolidation. If you look at the 70s, 18 to 20 years of expansion, which was 1982 to 2000, consolidation, and now we're about halfway through expansion. So most people think, well, it must be the top, it must be 2000, everyone's getting excited about Palantir, everyone's getting excited about NVIDIA, we must crash. I don't think that's the case. And if you actually overlay demographics over this, the commonality between the periods of consolidation, like 1930 to 1948, 1968 to 1982, is demographics. And right now we have very favorable demographics, as many of you know. The bulk of our population, the echo boom, is 33, 34 years old, housing formation, family formation. So we've got a lot of gas in this tank, and if Slumer's right, a lot more upside. I know Denny talks about 10,000 on the S&P. He's talking about, just based on past trends, as high as 14,000 by the early 2030s. Okay, turnaround pick. This is as boring gets. So if you get excited about Palantir, you are going to fall asleep about Cooper Standard, and here's why. They make the rubber ceiling that goes around the windows and the doors of automobiles, okay? Who's excited about that? All right, so this was a $146 stock in 2017. We started building a position for clients in May of 2022. We went public on Fox Business at around 550. And you say, okay, well, where were you in 2022? Why are you telling me about it now when the stock's up 3x, it's up 200%, about a $15 stock? Because it's been de-risked and the story is just getting started. So what was happening in 2017 is you had a sell-through in the United States of about 17.5 million cars, okay? We fell in this cycle down to 15.3 million. If you go back over the last 45 years, every cycle, peak troughs in the low 15s, every cycle peaks in the high 17s to low 18 million. Right now, we're at 15.8 million SAR. The operating leverage of this business is such that they've taken all the costs out of the business, and every few hundred thousand cars as we go from 15.8 of the bottom of the cycle to 17.5 or 18, this business can generate $3 a share in earnings, okay? When we got involved with this stock, you had something terrible called solvency risk, okay? Those are two words you generally don't want to hear when you're getting into an investment. They had to refinance about $1 billion worth of debt in fall of 2022. And legend, over here, David Kotak, who's one of the best bond people in the business, an absolute legend over decades. I just had a chance to meet him. He's going to speak next. Can tell you in fall of 2020 was not the best time to refinance high yield debt. It was a scary time. The markets were closed. And we got in on the basis that they had more than enough asset coverage that they would get it done one way or another. And number one. Number two, there was a lot of private credit swirling around. So if they couldn't get it done on their own, we could find a way to get them in front of people with private credit to get it refinanced. Long story short, they got it refinanced. Goldman charged them an arm and a leg and 3, 4, 5 legs, but they got it done. Refinance risk was off the table, and the stock shot up, $5, $10. It shot up to $20. Now back to 15. Now, I'd love to say I'm a genius and I thought of this all by myself, but when I was asked, I asked, some people asked, what would Jesus do? I asked, what would Warren do? I also asked, what would Charlie do? And I copied this idea from Charlie Munger, who did the exact same trade in one of the cyclical auto troughs in 2001 with a little company called Tenneco. Okay, who's heard of Monroe shock absorbers, Dynamax exhaust products, etc.? And here's the beauty of what Charlie did. He read an article in Barron's about Tenneco having to refinance about $1 billion of debt, and he put $10 million into the equity. And from that $10 million, when they got refinanced and the cycle came back, he turned the $10 million into $80 million, and then he gave the $80 million to a guy named Li Lu, who started investing in China when no one was interested in China, and he turned the $80 million into $500 million. So 2 chess moves, $500 million. Who's interested in that? Okay? So was Charlie buying the things that were already up 10x, 20x, 30x, or was he buying the things that were out of favor, that had a catalyst to turn around to take advantage? The latter, right? So that's exactly what's happening right now with Cooper Standard. We've met with management multiple times. We have confidence in their abilities. They also, a lot of times when these small cap companies get into trouble, they don't respect equity. So they issue a lot of shares, they dilute the shareholders. They've actually brought the share count down while going through one of the most difficult periods in the auto industry. This is turning up. We've already troughed the operating leverage. They're now at break even. They've taken $500 million of costs out of the business. As you see, and the number one leading indicator of industry auto volume for new cars is incentives, okay? And you'll see here, incentives, first off, this chart on the top is the global light vehicle production forecast. So as you can see, this is very conservative right now because people are still pessimistic. They expect it to go back to 2017 levels by 2028. We think it's going to happen sooner. But on that basis, Cooper Standard at that peak level earned $7 a share, $7.19 a share in earnings in 2017. The stock traded at $146. We believe when we get those type of volumes, whether it's 2027 or 2028, based on how the business has been better managed, they're going to earn well more than $7 a share. They could earn $10 a share and beyond. And the only question is, what multiple is going to be applied to the stock? A trough multiple of 10 times or a peak multiple of 20 times? So we think it's got huge upside, even from $15, never mind $5. This will be a 10 to 15 bagger over time for us. So that's that. That's the incentives you can see going straight up. And if you thought that one was hairy, okay, I got one that's even hairier for you. It's called Advanced Auto Parts. You guys ever seen an Advanced Auto Parts in your neighborhood? Okay, this is the worst performing auto retailer of all three, okay? So whether you're talking about O'Reilly, et cetera, et cetera. The good news is they probably have the best CEO who's just come in. His name is Shane O'Kelly. He ran HD Supply for Home Depot. $7 billion business. He's got a military background, Harvard Business School. He knows how to run these businesses. And what he's basically done is he took solvency risk off the table recently by selling the Canadian business that was non-synergistic. He created $1.5 billion of cash for that, net 1.2, paying down debt. So he's brought the leverage ratios down to buy him time for the turnaround. And then he closed 10% of the stores on the West Coast that were all spread out. So you see that footprint of all the red dots? all of those on the East Coast is great, where in most markets they're number one or number two, and they have synergies and they have opportunity to really generate cash. They sold to Canada, paid down the balance sheet. They closed 700 stores on the West Coast that were all spread out. And now they're going to lower the distribution centers from 38 to 13. He expects to increase operating margins by 500 basis points over the next few years. What that means in English, they're going to generate $600 million in operating income. And on that basis, the last 2-3 times that they generated $600 million plus of operating income was 2018, 2019, and 2022. The stock is currently 45 bucks. In those instances when they were generating that type of operating income, the stock was $186, $182, and $240. I'm not saying that it's going to go back there, but I am saying there's an enormous opportunity. Again, operating leverage, catalyst, it's been de-risked, solvency risk has come off the table, they sold off non-core assets, same type of story. And this is how we can create doubles, triples, and stuff over a reasonable amount of time, be patient, build the position, and wait. Good things come to those who wait, right? And then finally is Etsy. Who's heard of Etsy? Okay, so you have two choices in the next 3 weeks. You can go onto Amazon, you can scattershot a bunch of chocolate baskets that's no one's ever gonna eat, unpersonalized. Your business clients, your family is going to say, oh, yeah, you did the minimum, congratulations. You thought of me barely. Or you can go onto Etsy and get them something beautifully engraved with the most important thing to every single person with their own name on it, okay? And get a customized thing. And they've built a tremendous business in doing customized stuff. It was a COVID darling. The stock ran up to over $300 a share. It's now, we initiated at $49. I think it's still, what is it, Jeff? $49?
55.
55, okay, so we're up on that one, barely. But here's the name of the game, ladies and gentlemen. When I talk about a framework, looking under the surface and understanding what you buy, I think about it in terms of private equity in the public markets. What would I pay for the entire business if JP Morgan was going to finance me to buy the whole company, and I had to put 100% of my net worth up for the equity of the purchase? Look at those purple bars are the free cash flow generation of Etsy. So does it look like the free cash flow has gone down a whole lot since the stock was trading at $300? Okay, so if the stock was priced, Mr. Market is a manic depressive and a manic euphoric. Okay, so you're seeing a little bit of the manic euphorics a little bit this week, and some of the manic depressives in stock like this. But when I look at this, if you were going to go buy 10 Jersey Mike's franchises, is that big down here, the Subway shop? And you looked at the guy, you would look at the financials, by the way. I know a lot of people don't like to look at financials before they buy a stock, but if you were going to buy a whole business, you would look at the financials, right? And if the free cash flow, the amount back to owners, back to you as a purchaser, was basically the same over the last 10 years, would you try to buy it at 20% of what it was worth a few years ago? The guy would literally call security guards and have you escorted out of the building because you were insulting and you were completely irrational. Except every day in the public markets, you get opportunities like this where if you had actually presented to the board, I'll buy the whole company at the price that it's quoted in the market, they would call security to have you think you were a Looney Tune, but that happens every day. So stock price down 80%, free cash flow generation to owners, not only about pari passu with when it was a $300 stock, but re-accelerating growth. They're turning it around. They did make some mistakes, but they did keep 92 million users. It's the fourth most trafficked website for e-commerce site in the US. How many of you knew that? Etsy. I had no idea. I had to ask my wife, what is Etsy? Does anyone use it? And that's one of their initiatives. Loyalty programs they're initiating, downloaded apps, gifting, international, all of these initiatives. And Josh Silverman, who is the CEO, has a proven track record of winning. When he was at Skype, they increased users by 300 million in just a few years. He's got a track record of many successful companies, and he's going to do the exact same thing at Etsy through some of these initiatives. So men, international, gifting, loyalty program, apps download, and cleaning up the curation of the website, etc. There was a period there for a couple of years where they had some counterfeit and cheap products, and that kind of turned people off. They're fixing that problem. You know, I had an anchor ask me, like, are they doing a good job? And I said, the answer is no, the stock's down 85%. That's the bad news. The good news is they recognize the problem, they're fixing it, and we're seeing re-accelerating growth. And this is a phenomenal niche platform. The other reason I like it, it's not a Me Too platform where everyone's selling the same product and it's a race to the bottom with price and margins, which you're never going to win against Amazon, right? They don't have to have the same type of margin. Here, it's bespoke products, it's custom products, it's gifted products, it's supporting small businesses, and the runway is just getting started if you look at the total addressable market, etc. By the way, anytime you hear in an investment presentation, if you hear the word total addressable market, what they're trying to tell you is, here's why you should pay 20 times sales for this business. Run the other way. But in this case, it's trading at a meaningful discount, and they have a very small percentage of this growing narrow group. And I have one final bonus stock turnaround Tom pick for you today. And that is, oh, by the way, my analyst Jeff put this beautiful slide together. They're generating about $600 million of free cash flow every single year. Does that sound like they have solvency risk? No. Okay, the balance sheet is delevered. The free cash flow is growing. Over the next 5 years, they're going to generate about enough cash where you can buy in 60% of the stock. They just announced a $1 billion buyback authorization. So, $1.2 billion of cash on the balance sheet, $2.3 billion long-term debt, re-accelerating growth. We like these type of opportunities. And finally is Boeing. You can't give away this stock. People are trading it like it's going out of business, except they've got a new CEO, Kelly Ortberg, who, when he was at Rockwell Collins, in 6 years, he 4x'd the company for owners. He made them 4 times their money in 6 years. This guy is an absolute winner. They've solved the issue with the unions. And by the way, they've got a $500 billion backlog. The demand for flying is going up, not down. China's going to double their fleet by 2043. And they've got a $500 billion of backlog. Imagine if your Jersey Mike's Subway franchises had 10 years worth of backlog for sandwiches, orders already in queue, already committed, already paid for, and there was no other Subway shop that they could go to if they got tired of waiting. In the case of Boeing, you got Airbus. We like duopolistic and oligopolistic businesses that have pricing power. Boeing is one of those. We see a tremendous opportunity there. And then finally, this is how to reach me. The podcast is the best way to get value from me for free. Just tune in and listen. You can get that anywhere you get podcasts. It's better on YouTube because I go through a lot of charts, data, spreadsheets, etc. Hedge Fund Tips with Tom Hayes. Twitter is @HedgeFundTips. The YouTube is the way to get me, @HedgeFundTips. Email and phone number. And as always, this is opinion, not advice. We deal exclusively with ultra-high net worth individuals and family offices. So talk to your financial advisor before you do anything, and happy to take any questions.
Okay, we'll do 1 or 2 questions now, and Tom's going to be on the panel later, so if you don't get a chance to ask now, we'll definitely have some time for that. I'm standing here with the microphone. Yes.
So Amazon is what the biggest company really to consumers.
Yeah.
There's these Chinese companies coming in, Hedge and Temu, and
Yeah.
are there investment opportunities with those as well?
You opened up a can of worms, because if I start talking about Alibaba today, we're going to be here till 4 o'clock. Look, we've got a tremendous position in Alibaba, okay? And this has taken longer than we've expected to work, but we've had an opportunity to bring down our basis. In our view, it's the best, price is what you pay, value is what you get. We think it's the best opportunity globally. Their international business, to your point, Alibaba Express is growing at 30%. Pinduoduo is a competitor with Temu. I think Temu, if Pinduoduo, I believe their numbers are either unsustainable or unreliable, and you're seeing them get shut down in a lot of markets like Vietnam
Alibaba does quality business, and Alibaba is the toll taker in China. If you believe that the government will continue to do stimulus, if you believe that they will recover like they do every cycle, just like autos recover every cycle, and it's the cheapest covert AI play in China because they are the #1 cloud provider, and what they do is with every AI startup, they say, don't worry about it, you don't have to give us money. We'll give you compute power, which costs us basically nothing. You give us equity. So they've got equity in every single startup, in AI startup in China, and that's given zero value right now in the stock price. You're going to see some of these things be $1,000, and we own them indirectly as owners of Alibaba. So that's a perfect play, and it's one of our largest positions, so you're spot on.
We'll do one more over here.
Yeah.
What do you think about Supermicro? Will they get their financial reporting issues taken care of, and their future, please?
Supermicro, wow. That was one when it was going straight up. I said, what would Jesus do? And then I said, well, Jesus didn't give me an answer. I said, okay, what would Warren Buffett do? And Warren Buffett wouldn't touch it with a 10-foot pole, so we took a pass. As far as companies that have accounting irregularities, that is a huge red flag. Obviously, there's substance to their underlying business, but when you have that type of thing, it's a don't touch. And I live my life under a very simple framework. I am perfectly comfortable with making errors of omission. Like, I have no FOMO. FOMO is not in my DNA. Like, if I see someone make 100x on something that I wasn't participating, like, I'm super happy for them. Like, I don't think my way is the only way. I just figured out, after doing it long enough, I'm really good at one little thing, and this is what I'm good at, and I just do that. And there are tons of ways to make money. So, the short answer to your question is I don't touch companies that have a history of accounting irregularities. It's just a don't touch because, if you see a few cockroaches, you don't know how much damage is underneath the sheetrock. And for me,
you touched it at exactly the wrong moment.
What's that?
What if you touched it at exactly
Oh,
the
and
wrong
you're
moment?
in it. You're in it and deciding
At
what to do.
exactly the wrong moment. Right before the problem.
Oh, okay, right before the problem. Sometimes you got to take your lumps. We all do. I would say two things. Number one is if you're going to harvest a loss, if you have gains in other stocks that you're going to be paying tax on next year, you might want to harvest that loss and use that tax asset against the gains. Now's a good time to do it before the end of the year. Opinion, not advice. But if you're going to hold on to it, you better get on the conference calls and be very darn sure that you feel comfortable that the error was explainable, rational, and you feel comfortable in the financials. And then again, price is what you pay, what you get. Even though it's fallen down, what is the value of it? How much, are you comfortable with the current valuation, assuming that it's correct? But for me, I run the other way from some of those guys. Yeah, I think that's it. Thank you very much.
And we're back. And then we had a segment, panel segment, which I would strongly encourage you to listen to. You can find it on YouTube. Just Google Hedge Fund Tips. It's called Part 2, the panel. That was with Mish Schneider, who you see all the time on Charles Payne on Fox Business. It was great to be on with her. And legend Sam Stovall, who's been a market strategist, also had dinner with him. And Jose Torres from Interactive Brokers at the Scott Walker, former Scott Walker, governor of Wisconsin event on Thursday night. This was a great segment, but we're not going to take 30 minutes to play it. I would encourage you, because we go in depth into emerging markets, China, and you might find that very helpful. We just have too many AMAs and stuff to get through today. And finally, want to thank Deborah Sophia for including me in her article on Google. On to the data. S&P 500's price-to-book ratio approaches tech bubble peak. Look, if you listen carefully to my presentation, I alluded to the fact that 99% of the speakers that I saw over those 3 days were talking about things that have already gone up a ton, as if they're the newest, best idea ever, and none of them, or few of them, were to be found at the bottom in the hole in fall of 2022 when we were buying Amazon and Google and made easy doubles. So it's just something to be cognizant of. It doesn't mean it can't go more. It just says some of these valuations on the concentrated MagSev are stretched. As a matter of fact, one of the things we're going to talk about today is the fact that since I posted that article on June 20th with Jensen Huang on the cover of the article, you can go back to Hedge Fund Tips commentary, signing that girl's front area with a marker. NVIDIA has had negative returns since June of this year, and you would not guess that based on the continued euphoria around the stock, okay? And it's something to be cognizant of. So price to book, tech bubble peak, it doesn't mean we're going to crash or tech's going to crash or anything like that. I think it does mean they are going to underperform relative to the unmagnificent 493 and ex-US, and we're going to talk about some reasons why. This is beauty to my eyes. This is the Cox Automotive. Incentives are booming. We jumped up again. I think we were at 7.6 the last time. We're at 8% of sales price. Sales prices ticked up a hair, but they've been basically flatlining for the last 2+ years. Incentives are going up. What is the number one key indicator of future volumes is incentives. And this is exciting, especially when we got a 16.5 mil SAR number last month. When you annualize it out, we are moving in the right direction as per my presentation. But this data is new as of today. Annual new stock buybacks continue to climb. Overall distressed rates by property type. You'll see that office is still climbing a little bit. Retail is leveling off, and self-storage is rolling over, as well as industrial rolling over. You had a little bit of spike in the summer, and that's come back down. 007, Wells Fargo sees the S&P 500 at 7,007 in 2025, highest forecast on Wall Street. So again, this is stuff that you see all the time. Opinion follows trend, which leads me to believe it's probably overshooting in the short term. We're going to talk about some targets out there. Our base case is 8 to 12% next year, maybe a little lower, because the index is so impacted by the weights of the Mag 7, and we think they're going to perform less well along with the closet indexers, and we'll talk about why. It has to do with correlations, which are at an all-time low. U.S. Beige Book Activity Index, that's turning back up. Says economy stable, companies more optimistic about 2025, but tariffs a worry. What you saw from Trump, number one, he extended a long olive branch to Xi Jinping this week by inviting him to his inauguration, number one. And number two, he's put people around him that understand that if we destroy China, it's mutually assured destruction. And certainly we want to extract more tariffs and put America first. And at the same time, we want to benefit when we can benefit from those areas that we want to get certain goods at lower cost that are, we're unwilling to produce here. And there's a beneficial nature to that type of relationship. And I'm sure they'll find their way to the table, starting at 60%, then dropping to 25%, then inviting to the inauguration. You can see a trend here if you're paying attention. Trailing 12-month PE ratios. I don't tend to look at a lot of trailing, but you can see tech is above their historical median. You got U.S. M&A at a low, just getting ready to tick up. That's not something you see right before recessions. What you see is a dramatic acceleration, and I think we're going to start that dramatic acceleration of M&A in the next 12 to 24 months, which puts the next cycle short-term top out probably a couple years from now. I think the rockiness is more likely in 2026 and a bit in 2027, more likely than not. than it is in 2025, even though we'll probably scare a few people early in the year. You see the Chinese CSI 300 breaking out, back testing, trying to move ahead this week. I think we're going to start to see some follow through. If past is any prologue, we've covered it multiple times in the last 2 weeks. What you see is as soon as the calendar turned before the inauguration last time, massive spike in moving along. Again, that skew index is elevated. The last time we were that elevated, you saw a sell-off in tech in 2022, and value stocks outperformed, so something to keep in the back of your mind. What we worry, percent of investors who think there's less than a 10% probability of a crash. Let me see if I can make this a little bit bigger for you, ladies and gentlemen. There you go. Right here, record 30 billion inflow into small cap funds, surpassing 29 billion in 2021. So that game's starting to go. I will say I'm keeping an eye on our KRE small cap. You know, we took profits on Bank of America and Citi over the summer after big moves. I think KRE's got some more juice and there's going to be a lot of consolidation, but it's also had a huge move, so I'm going to keep an eye on that after the beginning of the year. Annual distribution of S&P, total returns over the last 100 years. So you can see those years that had 15 to 20% returns, 30 to 35% returns. 30 to 35 happened looks like 11% of the time, and the bell curve here. So these years are, not normal, but they're not completely outside the realm of possibility. And if you look at the late 90s, which we're going to do today, you'll see there were several years strung together at that level. This is a different chart of that S&P 500 price to book ratio now exceeds the March 2000 highs. So you got to just respect this. Now you could say to me, well, that was a different time. The businesses were more capital intensive. There's something to be said for that, but at the same time, just pay attention. That's all. This stuff runs in cycles. All regions have now experienced a rise in valuations through 2024. Where is the most amount of value for the least amount of price in the scale relative to history and on absolute terms is China. That is going to be one of the surprises of 2025. It's going to work like magic, just like right after Trump got elected in 2027. After the inauguration, it took off. Scenario, U.S. equity sector impact from mass deportation. So the impact will be the greatest from agriculture, construction, and hospitality are hurt the most. Capital markets liquidity is just starting to recover. This is what you see after troughs. We are nowhere near the peak liquidity when you get up to 6-7% like you did in 2007, 2008, and 2021 before you got a sell-off, and 2000 before you got the tech wreck. So we're just coming off the mat here. That's why there's a lot of gas in the tank, and that's why we don't see anything material. 10% pullbacks all day long. We're going to get one of those next year for sure. But, big pullbacks, 20% bear markets, I think that's going to be pushed off to late 26, if not 2027. So when the music's dancing, you got to get up. When the music's playing, you got to get up and dance. Credit spreads coming down. Here is another reason you do not want to get bearish into a global easing cycle. Central banks cutting rates at the fastest pace since May 20, 62 cuts already this year. Just getting started. Last two times, May of 2000, we were pound the table buyers. April of 2009, these were times to be buyers, not sellers. Currently takes 8 months on average to build a single family house. So that has started to rise again in the last 4 years. That could have something to do with supplies. It could have something to do with regulation. Hopefully they can make it easier to get zoning and get the supply that we need going. And this will start to come down, and that will be positive for affordability for young people trying to start a family. Encourage more people to have babies, which we need as a society. This is the spread between the household survey and the establishment survey. So while the establishment survey for the employment levels was positive, under the surface it wasn't that great, which is why you're seeing 96% odds of a hike, 90% odds of a cut next week. And I think that's all we're going to need for a while. And I think after that, I think they can play the wait and see game and maybe sit on their hands until March and 1-2 more cuts in 2025, and we're done. We got a mid-cycle intervention. They went big early, and they saved the day. And I think that Powell is going to go out like Seinfeld at the top and do exactly what he wanted to do. That's not to say inflation's not going to come back in fits and starts, but I think he's going to largely be able to declare victory. And part of that's going to be a function of Doge cutting costs. We're going to talk about that as well. Mark, this is the U6 unemployment rate. Underemployment has been going up since 2022, so keeping an eye on that. That should keep the Fed easy for a little while longer, well into 2025. Rate cut in December, we covered that. 2-year yields dropped. They kind of did a dead cat bounce here in the last few days, but they've been coming down since November as we anticipated. Bonds get bid in November, December, and that should follow through in 2025. Consumer sentiment is ticking up since the election. Here's the NVIDIA, okay? So it peaked out at 140.74, literally the day before I wrote that article on June 20th. And since then, we've had exactly zero gains. First, we had an immediate 35% drop. So that was pretty nice call. And then we recovered, and now we're back down to literally negative. This is the hottest stock that people can't get enough of. Down at, wherever it was in the 2020 lows. You couldn't give it away. Now everybody wants it, and that's why you're seeing some distribution here. The question is, what will be the magnitude of this distribution? And I think, like I said on Stu a couple weeks ago, I wouldn't be a buyer. That's all I can tell you. Record inflows for U.S. ETFs. So again, this theme, I saw it, felt it, heard it over the week. U.S. only, don't touch international, pile into all these stocks that are trading at 40 times, 100 times sales. It's going to be okay. They're going to change the world. And all day long talking about TAMs. The minute people start talking about total addressable markets, run the hell out of the room. Because it's just code to sell you something that's trading at 10, 20, 30, 40, 50 times sales, which on average, with the exception of the ZERP environment of the 10-year period from 2019 to 2022, where you actually made money buying stocks trading at 10 times sales and making no money. Every other decade since 1890, you got decimated. Decimated in the sense that they carried you out in a stretcher and you never came back, and you joined the military, or you went to flipping burgers or driving a taxi. And I think as rates normalize, the people who are buying 20, 30, 40, 50 times sales and losing money or making a little bit money are going to get carried out in a stretcher. So, percentile of sentiment indicators, you can see here it's getting frothy. And if you look at the things that are moving, not dissimilar to 2021, not dissimilar to 99, 2000, you want to avoid those. And even if you get a pullback in those groups, and you're buying quality under the surface, which has been, right now we are in tax loss selling season. So from December 10th to December 20th, you will see some weakness in the things that have been weak before the Santa Claus rally. And then they'll start to get bid as we turn the calendar. So just be cognizant of that. This is the country composition of the MSCI World Index. It's like US is like 67% of the index, and some I don't know, it's like half of that in terms of global GDP. China is 5% and like 16% of global GDP. So this is an extreme. The rubber band is stretched as far as the rubber band can go, and it's going to revert back. Exports from China picked up just after the election, so people are front-loading stuff. Sentiment around the consumer reached the highest level in almost 3 years in Q3 earnings calls. Second half of December has historically been the second strongest period of the year. So after the tax loss selling is done in the next handful of days, we should see some strength into the end of the year. This is Mike Zaccardi. Since 1978, dividends and reinvested dividends have contributed 69% of the U.S. stock market's total return, helping an $10,000 investment grow to over $1.6 million. 69% were dividends and reinvested dividends. So keep that in mind when you got companies like CCI and Stanley Black & Decker and great companies like that. Disney increasing their dividend by 33%. In the last 64 years, there were only 6 years where dividend levels declined and only one where they fell by more than 5%. The only time they fell was 2009 and the early 2000s. Every other year, they increased the dividends. So when you get the chance to buy a great company that is down a lot in price and you can lock in an aberrational yield of 4, 5, 6, 7% with a dividend grower, you wind up with these situations like Buffett did with Coca-Cola in 1999. I think he gets more dividends per year from his Coca-Cola position than his initial basis, because not only do you lock in a great yield, but the dividend continues to grow and compound over the years. And that's where you wind up with these huge yields with no taxable capital gains. You pay dividend income over those years. That's pretty exciting. Dividends have grown an average of 5.7% a year, more than 2% above the rate of inflation. This is from Jeff Hirsch over at Stock Traders Almanac, talking about the seasonal pattern for small caps. Gets strong mid-December and all the way through March. So that benefits companies like Cooper Standard, like Goose, like some of the smaller Comstock Resources is off the charts. That's almost a double already. As a matter of fact, I had a friend email me today. He said, my first 2 doubles from Hedge Fund Tips with Tom Hayes. So I was excited to hear that. He had, I think his doubles were Comstock and Generac. If he didn't make Generac, or he's just a couple dollars short with Generac, so that's exciting. The second theme. Okay, so what else do we have? This is the most important chart in my view. The backdrop for stock pickers is the best in 25 years with correlation of stock performance at all-time lows. So when did we have this last? You had in 2017-18 after that big drawdown from 15-16, and you rallied straight through 2020. You also had it in of course, the 2003-2005 period when small caps and international took off. And you had it in earnest in 2001, which we cover almost every week, comparing it and the stage set prior to the biggest rally in the shortest amount of time. From 2002 to 2007 for emerging markets and for small cap. Second theme focuses on Trump's pledge to make for an easier regulatory backdrop. Financials, manufacturing, and energy are key focus points. They expect financials could see the biggest impact from the deregulatory stance, but also that small and mid-cap stocks should outperform given their higher domestic U.S. exposure, especially those exposed to financials and industrials. So U.S. exposure, you're talking small caps, and that should be, and I think the surprise is going to be it lasts, 4 or 5 months, big rally, and then it kind of cools off for a little bit when the honeymoon is over, and then we see the policies and the impact and all that stuff. This is the long-term price channel. We've been riding the bottom for many, many years, and now we're working towards the top, and that's how Deutsche Bank gets to this 7,000, 7,100 target over the next year or so. We shall see. Optuma. This shows the trough in December tends to be the 15th. before rallying into the end of the year. So maybe a little more wobble into Monday, Tuesday, and then Santa starts to come to town after the tax loss selling is in the rearview mirror. 1 year price expectations for rent rolling over. This is good for long-term inflation. This argues against the Arthur Burns fear that Powell has lived with for many years of inflation coming back like in the 70s. Here we go, financial outlook. Much better off. And then let's pull up some Slumer to see some long-term charts from RBC. Trend and cycle. Here we go. Okay, here's the S&P. A lot of people looking at this 6,600 target. I guess that's some Fibonacci extension level. Then you've got 7,000 for 261 extension. That's probably a year and a half off. 50,000 on the Dow. That's a 261.8 extension they're talking about. Man, there's a lot of bullishness in all this. Just be careful what you're buying, because the beauty is if you buy it enough under intrinsic value, even if the market pulls back because these high flyers get smoked, you don't have to worry about it. And if you're running low to no leverage, you definitely don't have to worry about it, and that's where we like to play. NASDAQ's looking strong here, breaking out in the short term. Semiconductors, keeping an eye on. Intel was up a little bit today on the, they're going to IPO one of the pieces of the business. So they're getting into action, turning it around. They just need to announce a CEO. Small cap 600, again, just breaking out. If you look at the next target on that, it's up about 20%. And then if you go to 268, it's probably, 30, 40% higher, which would be constructive. Europe is right here. Europe is easing and easing aggressively. So I wouldn't discount Europe. I think there's a lot to do ex-US. I think emerging markets is better bang for the buck, but there's going to be some opportunity in Europe as they push through here. Emerging markets came back to retest. You had that big breakout in September. Retest, now it's starting to move back up. No one believes it again. This is when you get the most violent upward moves, ladies and gentlemen. So hang on to your seats. Whether it starts before the flip of the calendar or not, who knows? But I think, after the flip of the calendar, certainly after inauguration, I think we're going to be in rocket launch here. And I'm very excited about it because I just love that no one believes anything. The things they announced this week were so bullish and people are just like, it's because they bought, when Baba shot up to 120 in September, they all bought up. And then they got smoked out because they didn't believe it. And Tepper went on TV at 117 or whatever, got everyone in. They pulled the rug out, took it back down below 100. And now they're going to rip it higher. No one's going to get in. It's just going to keep pushing up, pushing up, pushing up. All the sellers are out. It's textbook. It's been brutal, but it's textbook. And I just love it because we're going to finally benefit in such a big way that when all is said and done, with the ability to lower the basis so dramatically, I think everyone listening to this now is between the low 80s to the mid 80s in terms of BABA. Some of you have KWEB. And when this thing rips, we are going to mint so much money. It's unbelievable. I mean, it's just, and we all have bigger positions than we ever could have imagined. Compliments of Xi Jinping. Tokyo Stock Exchange, no interest. Hong Kong, Hang Seng Index. So this is what it looks like, ladies and gentlemen. It is what we call lower lows, higher highs, and higher lows. That is called an uptrend. Doesn't feel like it. Everyone's nervous. I love it. I absolutely love it. This game is just getting started. And we are excited. So you can see these different, this is the daily breaking out the downtrend line. This is the weekly, just doing this stair step up right before a parabolic move higher. Here's the 10-year yield. Remember here, everyone said 5. We said no, this is a counter trend rolling over. That's exactly what it's doing. US 10-year yield rolling over. Dollar, little fake out above this resistance line, now rolling back over. All in line. Everything is playing out perfectly. And the temporarily detour is Trump got elected, surprised the Chinese a little bit, and they did the exact same playbook that they did in 2016. I don't know, like, I'm not asking them to read history from like 100 years. Like, it's amazing how short the memory is. This is literally 8 years ago. No one remembers. They did the exact same thing. Trump says, I'm going to tariff you. The Chinese said, no big deal. You want to tariff us 20%? We'll devalue the yuan by 20%. Like, this is not rocket science. And then Trump's like, oh, wait, well, then we don't really get any benefit. No kidding. So then you get to the table and you come up with a deal and everyone's happy and everyone makes money. And that's the name of the game. And the exact same thing that's happening, which is why you saw a little strength in the yuan, in the dollar. The Chinese, Trump got elected, dollar rallies, bonds sell off. Same thing after the inauguration, bonds rally, dollar sells off, emerging markets go up, just against what everyone positioned for, what everyone expected. It's the same thing happening, part two. Canadian dollar, hang in there, loonies, even though your governor is not doing a great job, Governor Trudeau of our 51st state. If you can't take a joke, the Canadian dollar should start to see some strength. Crude, bottom end of the range. I wouldn't be surprised if this starts to rally. What else do we have here? Gold, everyone wanted it up here. I think that's going to continue to weaken for some time. Same story. Copper, I'd be a buyer of copper with China coming back online with stimulus. They're going to do, quote, whatever it takes. I like that trade. China, new cycle. Here we go, ladies and gentlemen. And I'd also start to pay attention to some of the staples that got beat down, emerging markets, healthcare. No one wants healthcare. And, some of the oil stocks, I know they're not all going. Well, look, we like Comstock Resources. We're just staying. We can talk about energy all day long. We're just going to stay with Comstock Resources. We love it. And it's not near intrinsic value yet. But it's running there, that's for sure. What else? By the way, here's the sleeper. Forget about Boeing running. What about PayPal? Back over, in $90 from, you couldn't give it away at 58. Everyone wants it at 90. Here's Alibaba, breakout, back test. Here we go, ladies and gentlemen. What are these, fib extensions? Or is this a... Yeah, well, this is going to be fun, ladies and gentlemen. All I can tell you, I love this shakeout. Back to this moving average, and we're starting to bounce back up in fits and starts. And same thing with Tencent. It's the whole group. This is going to be the biggest surprise that no one sees coming. And they're all going to be stuck in these things and get the rug pulled out while the thing that everyone hates is going to take off, and no one's going to figure it out until Baba hits $200, $250. Then they're all going to come running, and they're going to create our liquidity. And we're going to say, sold to you, sold to you. Just like in Trading Places with Eddie Murphy and Dan Aykroyd. And it's just going to be beautiful. Regeneron Biotech, ladies and gentlemen, time to buy. If you didn't buy at the lows with us, now's the time. Deals in drugs, deregulation. The game is on. Nothing's changed. It's happening in price now. We're going to make up the IRRs like it's going out of style in 2025. Constellation. Okay. QSR. We got, okay, so that's that. Moving back here. Shanghai Property Index starting to take off. What I saw in the headline, prices down, sales up. So there's starting to be some activity. NASDAQ at the top end of the range. So it's either got to break out and build here or come back down to the bottom. Based on some of the valuations and everything else. Now, here's what's important, and this is what I've been talking about all year. Profit growth estimates by sector. You could see last year, Mag 7 started at 50% earnings growth. Now it's dropped down to 18%, whereas many of these others were negative earnings growth. Now they are accelerating up to double digits and mid-teens. And healthcare, which is the most hated sector right now, is going to grow 20% next year. So we've got Baxter, we've got biotech, we've got to Baxter Biotech. I'm just trying to think if we need to add some more healthcare, and we'll keep an eye on that. Equity positioning across sectors. Okay, materials, I think that's the opportunity. We've got the Albemarle there, Comstock Resource. Financials positioning, not yet extreme. I'd like to see this get extreme before I really start to get antsy with the KRE. I think that's got a lot more to go, but I'm keeping an eye on it because it's moved a lot. Software revisions have shown strength recently. Oppenheimer 7100 target, opinion follows trend. Here's a divergence between TIPS 10-year yield and forward PEs. So one of these has to come down. TIPS yield inverted. Yeah, that makes a lot of sense. Asset managers are the least bearish on the dollar since 2017. So I don't even need to look at the chart. By the way, my goodness, ladies and gentlemen, talk about history books. We've covered this chart, but I don't even need to look at the chart to tell you they're the most least bearish is another way of saying the most bullish they've been since 2017. So let's take a look at what happened in 2017 to the US dollar. And here we go, ladies and gentlemen. I'm going to pull up my little Trump trade chart to show you what happened after the inauguration and after the election, which we've covered this multiple times, but I want to reemphasize because it's very important. Well, okay, let me just pull it up here. All right, USD. Okay. Here's Trump getting elected in early November of 2016. What happens? The dollar rips higher until January, right before the election. And what does it do in his first year in office, 2017? It literally collapses down all the way through the end of the year. And I think we're going to see a very similar situation that no one's positioned for. And what happened at the same time while the dollar was collapsing in his first year? Emerging markets were rallying, as well as China. BABA, same thing, turn of the calendar, straight up $84 to $187. Like, you guys can't even, like, you think that is such a foreign concept that could never happen in 2025 rather, because of pessimism and sentiment and all the noise. We had all the same noise in a different box and a different wrapper, the same shit, different day type of negative headlines for 1.5 straight years in 15 and 16, and then all of a sudden, straight up, okay? BABA, straight up. Emerging markets, do I have that chart? Anyway, you know what it does. It goes straight up. Watch. Let me pull that up here. Same thing, collapses after he gets elected, bounces around, turn of the calendar, inauguration, emerging markets doubles in a year. So, ignore history at your own peril. Listen to all the people chasing the shiny objects, and good luck with that. Here we go. What does financial success look like for Americans? So if you're in if you're a boomer, wow, boomers are pessimistic. They think you only need $1 million. If you're Gen X, they think you only need 5 million. Gen Z, you need $10 million or $500,000 a year salary. I think that's right. And I think for many of you in your 20s that are learning how to invest properly now, if you are patient and you are diligent, this is going to be a slam dunk for you guys. I mean, you don't need to invent anything. You don't need to predict anything. All you need to do is invest in yourself, do the best you can at your career, sock away all the money, compound it, and you will be set up according to your generation's definition of success. China PPI starting to turn back up. Here is the global easing cycle that we talked about. Here's the price to book on tech. So a little bit of contradictory stuff, but I think what it is I'm bullish under the surface in ex-US. I'm neutral on the things that have already run. I think they do okay. I think they underperform. And then you look at some of these indicators, they're not anywhere near extreme. So we're not at euphoria, which is like climbing the wall of worry, pushing that $7 trillion money market money back in. Buybacks are still going. Came down a little bit in the last few weeks. Price of diamonds collapsing. If there was ever a time to get married, it's right now, ladies and gentlemen, before the price of diamonds goes back up. Although now there are fakes, I think. They're making these carbon things. But, all right. Electric say no thanks to fiscal austerity. So they voted for people who are going to keep the party going into the late hours until the last call. Who holds the U.S. debt? This is kind of interesting. Everyone's worried about China selling off the debt. They own 2% of our debt. So Federal Reserve owns 15%. Mutual funds own 11%. Depository institutions that got whacked because of Powell forced them to buy it all in 2021. Then he pulled out the rug from underneath them. They all had the mark to market. State and local governments, 5%. Pension funds, 3%. Insurance companies, 1%. U.S. savings bonds, 17% of U.S. treasuries. Japan, 3%. China, 2%. UK, 2%. Other countries, 15%. So UK owns as much U.S. treasuries as China does. That's mind-boggling when you think about it. U.S. small business optimism has gone parabolic, just like it did when? Right after the 2016 election. Guys, history doesn't repeat, but it rhymes over and over. We have these type of things if you just pay attention. U.S. small business optimism soars to 3-year high after Trump win. There you go. This shows from Dietrich, once a bull market gets 2 years old, there could be a lot left. And it shows the history and kind of where we are right now is this little red line. So yeah, you could get some consolidation here. But there's a tendency for these things to go. I think we're halfway through the secular bull. Last 18 years, we broke out in 2014. We're 10 years in. We probably have another 8 years is basically where I'm at. And if you look at demographics, that fits in pretty nicely. One more bit of good news. November was huge for stocks. Big winner was small caps. Russell up 10.9% last month. Lower taxes, stronger economy. 22 other times the Russell gained double digits in a month. 6 months later, it's been a higher 90% of the time. A year later, up at 15% on average. Brazil's President Lula da Silva recovering after emergency brain surgery. I had no comment on that one. All I can say is keep an eye on his health because could be some interesting opportunities coming up in that country. Consensus expects 96% of companies to grow EPS year on year by 4Q 2025. Huge earnings breath, which means the 493 are back in the game. They'd been left for dead, and it's their time to shine in the sun. Here is insider buying. We covered that. This is bearish print, except for the fact that they're always early by many months. Here is the Hang Seng Index. Why am I showing you the Hang Seng Index in 2003 compared to 2024? Because this is the last time you saw the shift, the China to U.S. 10-year yield spread. The last time that it got this low, negative 200 basis points, was basically 2001, and then again in 2004, 2005, and you can see what happened following this period where you had this spread in yields. You had the biggest rally in the shortest amount of time in history. So all these things are setting up. No one's paying attention to it. Instead, they want to buy every stock that's been up, huge amount, triple digits. They all want to buy it now and be the bag holders for the people who are buying it in 2022. Manufacturing headwinds set to ease with the global monetary easing cycle in action now. So what you can see here is global manufacturing PMI has lagged the percentage of central banks easing in easing mode, which is now looks like it's at 70% of central banks are in easing mode. you can see PMI always catches up. That's manufacturing. Here, bounced off this trend line as we had anticipated. Everyone said 5, 5, 5. We said counter trend bounce, bullshit, and it's rolling back over. So now we're getting a bounce. People are going to start saying 5 again, and they're going to be wrong again. China Golden Dragon Index, breakout, back test, rolling back up. We're going straight up in 2025, in my humble opinion. This is all opinion, not advice. Go to hedgefundtips.com, click on terms, and forward PE ratio, again, skewed high due to those 7 stocks. Okay, this is interesting from Tom Lee over at Fundstrat, and what he's basically saying is we're going to have more subdued returns in 2025, and all the gains are going to be front-loaded, and the second half is going to be weak. I'm more in line with the front half is going to be more subdued, and the back half is going to rally. So his rationale for that is he looked at what I'm looking at is the presidential cycle after the inauguration. You get the excitement into the inauguration. You kind of get a little consolidation and weakness after and then the back half of the first year is better. Midterm year is worse. What he's looking at is just randomly picking all years where you had 2 years of 20% plus gains and what the pattern looked like. And they continued the gains into the first half, and then they got weak the second half. We buy good companies when they're marked down. That's what can I tell you? Mike Zaccardi going for 3 in a row in 2025, 5 of the last 7. So this is S&P rallied 20% each year from 1995 to 1999. Why that's an interesting comparison, and prior to that was the mid-40s and the early 50s, is because we just went through that mid-cycle Fed intervention like 1995, which we've been using as an analog for so long. So you got to be open-minded that next year could be better than everyone expects, but prepare for the worst. Expect the best, prepare for the worst is usually a good way to think about it. Investment sentiment is euphoric. That doesn't always mean something coming off these big troughs. It can continue, especially these big cycles. You bounced right up in 2009, 2010, but you still kept going. It bodes for some consolidation, and I'm thinking after the inauguration in February we'll get a little weakness, but we'll take it as it comes. Uncertainty and mean reversion drive gold speculative length. This is looking like net long managed money on the COMEX is looking like other previous peaks going back through 2016. You saw 2017, 2020, and now here's the gold chart. We told you up here that we wouldn't be buyers. We're kind of agnostic. I don't know if it corrects, but I think there are higher and better uses. 2025 year ahead, better first half, worse second half. That's what Tom Lee is suggesting. Political party in control, all red. Equity return annual going back to 1900 is 7.7% annualized, which is less than people think. So that's something to keep in mind. That also speaks to probably ex-US better. Dollar weak, ex-US equities better. We will see. I think, why you see these type of things is because you see dramatic change, setting the platform, setting the stage for the next phase of growth. So let's see what happens there. A tax cut to 15% from 21% is estimated to be 4% benefit to the S&P, with greatest benefit to consumer discretionary at 6.8%, communication services at 5.1%. Consumer discretionary, VF Corp, we love it. Here's NVIDIA again, no gains since that article in June. Structural underperformance interrupted by multi-year rallies. This is the euro area versus the US. This is a downward linear regression line with plus and minus 1 standard deviation. I think that this does bode quite well for Europe versus US in coming years. And it also looks to the earnings trend. And when you consider they're going to be easing more aggressively than we are, there's something to be said for that catch-up trade selectively, where you don't get burned by just taking a basket. You pick the best value at the lowest price, and you benefit from these mean reversion opportunities. It is do or die day here on the semiconductor index, bouncing up against this 50, 200-day moving average. This is kind of interesting. You see these if you drive along the Pacific Coast Highway. It blew my mind here in Southern California. They've got oil rigs right off the coast. I mean, it's amazing. I'm not going to go in through giving you a lesson on the different kind of rigs, but it's all here in one thing, and it's pretty cool to learn. So I would check that out. And Howard Marks, the desire for more, the fear of missing out. I literally, fear of missing out, like that gene, God missed me. When he handed out FOMO genes, he did not give me one. I love seeing people make money, and I do not care if I'm not involved in that at the moment, because I know if I stay in my lane, I have a repeatable, amazing framework that consistently works. I sleep well at night. My clients can sleep well at night. And we know over time, we're going to get these monster years, and we're going to get years that underperform, and then we're going to get dramatic outperformance all at once. When it comes all at once when you do this type of framework, because of the way Mr. Market works in euphoria and despondency and everything else. But when you're buying, I mean, look, the best lesson I can give you, ladies and gentlemen, is when you're buying the companies that we're buying, on balance, over time, cash flow and revenues go like this, and price goes like this, around the free cash flow intrinsic value. And what we try to do is we just buy when price is down here, even though cash flow really hasn't changed and revenue really hasn't changed. It's just slowly growing up on trend over 10, 20, 30, 40 years. The longer the better for us, so we can see how it acts through cycles. And then we get Mr. Market despondency for accumulation and Mr. Market euphoria for distribution. That's our model right there. It's not rocket science. That's all we do. So Howard Marks, fear of missing out, the tendency to compare against others, the influence of the crowd, and the dream of the sure thing. These factors are near universal. Thus, they have a profound collective impact on most investors in most markets. This is especially true at the market extremes. The result is mistakes, frequent, widespread, recurring, expensive mistakes. And that's what we aim to avoid. Like Buffett said, rule number 1 is don't lose money. Rule number 2, don't forget rule number 1. So, these high-flying, silver shiny things have their day in the sun until they don't. And then, these guys just disappear, and, you hear back from some of them 20 years later, and no one reads their bios to realize they blew up in the tech wreck massively, and they came back. But, the memory is short, and people just, they come back. They're like cockroaches. They never really go away. So individuals who cannot master their emotions are ill-suited to profit from the investment process. That's Ben Graham, Seth Klarman. Typically, we make money when we buy things. We count the profits later, but we know we have captured them when we buy the bargain. And finally, from Benjamin Graham, a great company is not a great investment if you pay too much for the stock. That is the name of the game. Probabilities of a cut next week are 96%. New traders are betting on a quarter-point rate cut next week. U.S. CPI brings no surprises, firming up Fed rate cut bets. Boeing stock is taking off. Here's why, from Al Root over at Boeing. We've covered the reasons why over and over, and now the rest of the market is starting to believe us. The fate of markets rests on Trump's dollar policy. It's going lower, ladies and gentlemen. He's told you what he's going to do, and that's what's going to happen. China's yuan likely to stabilize and strengthen, central bank says, after they devalued it against their early salvos with negotiating with Trump. This is from Ryan Dietrich. Now the bears are apologizing. So you had Mike Wilson, who got blown out, and then you had another perma bear who wrote an apology to people. I'm sorry, I've been so bearish for the last 3 years, and you missed 100+%, and yada yada yada. And then I see the guy the next day on TV, and he's bearish again. So it's just genetics, ladies and gentlemen. Boeing restarts 737 MAX production a month after the strike ended, so the strike's fixed. The MAX 737 is fixed. Kelly Ortberg's in the seat. What else do you want to think about, ladies and gentlemen, and 10-year backlog? Here's why Disney is doubling down on cruises with a $12 billion spending spree, because it's got a high return on capital, much higher than its weighted average cost of capital. That's why. Nothing else to think about. Boeing to lay off hundreds in Washington state as company-wide cuts continue. I think many of those will be the people that were striking, and that's the way it goes. But they're going to take those costs out one way or another. If everyone else wants a bigger raise than the market, then they will just cut back on the people that they need. China's Politburo mentioned these two words for the first time in more than a decade, stock soared, and those two words it was, I think, loose monetary policy. Let's see. Implement more proactive fiscal policies and moderately loose monetary policy, which moderately loose regard to central bank policy in 2011. So this is a big deal, and you can go back and see what the stocks did. Ant Group gets new CEO as billionaire founder Jack Ma talks up AI in rare appearance. The fact that they own a piece of pretty much every AI startup in China because they give them compute power credit in the cloud is something that no one else is talking about. It's going to be one of the greatest value unleashers in the next few years. China's new monetary policy echoes 2008 stance. We just covered that. Chinese premier vows to do everything possible to expand demand. Everything possible to expand demand. And the market's like, shh. What about Trump? What about Trump? He's going to hurt them. Just like he did in 2017 and 18 when they all tripled. Americans' cars keep getting older and creakier. That's good news for Advanced Auto Parts. That's good news for Cooper Standard. Why investors fear the AI revolution and may face a Napster problem. Here's a great article from Charlie Gasparino. You can scrape all this stuff, but at some point you have to pay for the content, and that's going to slow that down. So just keep that all in mind. Doge plans to cut $500 billion from over 1,200 programs. Just 24 make up the most of it. That's deflationary. So for those of you thinking about deficits, thinking about all of that stuff, yields blowing out, think again. China has a lot of room to raise the fiscal deficit, Xinhua said. So we're lowering our deficit, lowering fiscal spend, lowering growth. They are raising their fiscal deficit, raising fiscal stimulus, raising growth, and no one's paying attention. Intel adds some much needed help to its board with stock on track for its worst year ever. Yeah, that is what it is. But look, we love buying it at tangible book. We love owning it in the 20s. We'll take a look in the 40s after the legacy business is fully valued, and then determine what they're doing with the foundries and what they're doing with AI. I think that there's going to be a reason to hold it after it's in the 40s, but we'll keep an open mind. Disney boosts dividend 33% after achieving streaming profit. That was a key part of our original thesis when you couldn't give it away in the 70s and 80s. Now, knocking on the door of 120, people are starting to pay attention. It's just getting started. Why investors need to watch Japan as a key source of market risk in 2025. Very short memory, ladies and gentlemen. Early August, what happened? The market got completely shellacked. Mag 7 in particular, as the carry trade unwound when Japanese inflation started ticking up and the central bank started hiking rates. Well, they're going to be back to it maybe as soon as this month. And I can tell you very simply, the higher the Japanese bond yield goes, the lower Mag 7 is going to go. Because when they're borrowing and doing the carry trade, it's all going into high-risk U.S. It's a play on currency. It's a play on free money. It's a play on speculation. And when that unwinds, it unwinds hard. And that's when the 493 become the flight to safety. That's when these guys get smoked. Money comes out of Japan. Money comes out of Mag 7. It's just getting started. 10-cent boss Pony Ma praises China's economic policy stimulus for the private sector. I don't know why these aren't opening. Here we go. Muted wholesale inflation rate likely gives Fed final go-ahead for Fed rate cuts. China's yield discount to treasuries recovered widest since 2002. We know what happened after that. Swiss National Bank takes leap with 50 basis point interest rate cut amid franc strength. Going to see more and more of that, ladies and gentlemen. Central bank easing globally. China sees needs to increase 2025 fiscal deficit cut reserve requirement ratio. Trump sends Xi Jinping an unprecedented invitation to attend the inauguration. That is the world's longest olive branch I've ever seen. Trump has options to mitigate the rising U.S. budget deficit, and those options are being led by Vivek and Elon. A wave of AI pessimism is coming. How to outlast it. This is a great article from Jenny Johnson talking about what we were talking about last week. This is the FT about the move from training the models where you need all the GPUs to inference where you no longer need as many. And then the game changes, and then like people, you'll get a little negativity, and then the story will shift from AI to quantum computing, and you'll have a new shiny object, just like it shifted from, data security and then SaaS, and then it's just a flavor of the week. Wall Street always needs something to sell. So you'll see that, but this is a trend that will last, and it'll just have a shakeout, and she explains how it's likely to play out, and I think it's a reasonable assessment. How Intel quantum chips could retransform silicon-based computing. So you had the big announcement from Google yesterday with their quantum computer and all the amazing things that can do in medicine and computation, etc. Big breakthrough. Well, Intel is at the forefront with chips, calling them quid bits, and you can read about that, and no one's paying attention to Intel, and they're going to be one of the key players in town as that new flavor of the week kicks in and Wall Street starts pounding the table on quantum computing, and they start to realize, oh, it's not NVIDIA, it's Intel. Whoops. Central Economic Work Conference release highlights domestic consumption revival. Deep dive from Brendan Ahern over at Crane Shares, K-Web ETF, and he goes into some detail about the announcements, implement more positive and proactive macro policies, expand domestic demand, stabilize the real estate market, promote the continuous recovery and improvement. Look, none of this matters till price goes up. Once price goes up, people start to read this and it starts to work. China vows bigger fiscal spending to boost consumption next year while we're doing what? We're reining it in. Article of the week, top 25 picks, stock market. So we went through some of this. Biggest surprises next year, USD weakens, energy stocks underperform, emerging markets outperform, retail stocks underperform, bonds get bid, yields compress. And I would definitely, here's where you can listen to that panel with Mish Schneider and Sam Stovall. Was a great panel. This is interesting on Intel. A friend of mine emailed me with some negative headlines on Intel this week. He said, quote, "It's been a long time since I've seen this kind of coverage on a single dog. It reminds me a bit of Global Crossing or WorldCom." I totally understand his view, and I'm sure a lot of people out there feel the same way. Here's what I had to say in response, which I think some of you will find helpful. Quote, "I think GE in 2018 is a better analogy of a mismanaged, hard-to-kill business that eventually turned around under the right management. WorldCom was a fraud, and Global Crossing was speculating on the future." So here's where GE was down 80-something% in 2018. You couldn't give the stock away. And these were the headlines. Why General Electric plunged 56% in 2018. The fall of a blue chip. This is when they got kicked out of the Dow. Hint, wink, wink, just like Intel just did. Wink, wink. By the way, what happened next? The stock was up 8x over the next 2 years, 700%. GE warns of bleak 2019, but promises a brighter future. GE has tumbled 25% in 2018. It's still too expensive. GE looks like the most expensive stock in its sector on a free cash flow basis, argues JP Morgan, et cetera, et cetera. So same thing repeated over and over. People just don't get it until they do. And then guess what? Now it's up 8x. Everyone wants GE once again. But what happened at the bottom here? They changed CEOs, and they got a guy named Larry Culp who changed the business. Same thing happened with VF Corp. Same thing happened with Advanced Auto Parts. Same thing happened with Boeing. Same thing happened across our portfolio. Every single one, and it's all working. And the same exact thing is going to happen with Intel. Same thing happened with Disney. You got Iger back. So it just repeats over and over. You got to be around long enough. Biotech, got to be in it to win it. That's going to be a big theme in 2025. And earnings growth here, top 30 stocks, last 60 days down 1.69. That's not the deal. The deal is deals in drugs, deregulation, pharma companies, record cash. They need to get innovation. A lot of drugs coming off a patent. They're going to have to make it up, and that's how they're going to do it. If you look at the other ETF, which is the equal weight XBI, which is what we're in, plus 138% over the last 60, plus 1.38%, top 30 weights over the last 60 days. Earnings estimates have come up, and now they're flat, 275 up 13-14% next year. That's a good thing. Data, you had a spike in jobless, in continuing claims were up and in initial jobless claims. So that forces the Fed's hand to follow through. And the podcast is over. We're going to stick around for some Ask Me Anything questions. A lot of you get great value. So let's get started. And okay. First question comes from Kyle M. Is there any indication that a December cut will be enough to get money market assets back into equities? You had previously shown analysis that they usually peak within 6 months of the first rate cut, but that could be expedited if cuts were heavier. Now 100 basis points in 3 months. Do you think CCI is well positioned at these levels with a 6.3% yield to benefit from that change if and when it occurs? Any updates on CCI in general? It's been a while since we covered it in depth. Yeah, I had it to cover in one of my public appearances, but we ran out of time. I'm a buyer here. I love it. All this is bonds sold off after the Trump election. CCI is a buy. No question about it. You want to lock that in. As yields compress, all these interest rate sensitive REITs will go up, and we think it's one of the highest quality ones in the bunch. So it is a screaming buy for us. At these levels, new money coming in would get exposure all day long for that. Next. Robert Evans asks, thoughts on carparts.com stock? Car parts. Oh, that's interesting. This must be a tiny company. What is that ticker? PRTS. Negative free cash flow, stable revenues, margins compressing. What does the balance sheet look like? Current libraries. Balance sheet looks okay. Wanted to understand why they have a consistent negative return on capital. Why is this such a crappy business? All right, 300, 600. What did they, let's see what they did to the share count. Yeah, they've doubled the share count since 2018. I hate that. I literally can't stand, nothing angers me more than management that does that. So, I think it's probably going to work as a trade, to be honest with you. I just hate management that are like that. So for me, it's probably a pass. But I think you're absolutely right as a trade. And I got to learn more about the business, but it's definitely worth digging into. But I would not place a long-term substantial bet with any management that disrespects equity and ownership in that way. Matt Mitchell. Hope you and your family are enjoying the Cali lifestyle. Was wondering if you've taken a look at Montclair, M-O-N-C. I'm guessing it isn't quite beat down enough and overlaps with your Baba and Goose positions. However, seems like a high-quality business trading and reasonable valuation for a long-term investor. Share issuance was to acquire another luxury clothing brand, Stone Island. Thanks for your work as always. Have been on board since the Wells Fargo and ExxonMobil days. Guys, go look at those charts. My God. Holy cow, that brings back memories. This was in the middle of the pandemic when oil went negative. Go back to the tapes. We were pounding the hell out of Wells Fargo. We didn't get it down at 18. I think our basis was 25 and change. We bought some at like 23, some at 27, and it was the quickest double. I mean, it was just unbelievable. And this was a scary time, but I was like, guys, it only traded down this below book value, this low in the early 90s, and in 2008 we got to load the boat. And then the second one, that was such an incredible year, by the way. And then the second one was ExxonMobil. My God, buying this thing down at $30. We didn't get the 23s, but we got the low 30s, and this thing just doubled so quickly. And then we took them off in late 2021, and then like all the people that hated energy down there. And it just went up. They couldn't get enough up here. And it's done basically nothing for 3 years. And for 2022 and 2023, everyone's like, energy, energy, and energy. None of them were here down here. And my goodness. Well, thanks for bringing that up, Matt. That was awesome. And let's try Montclair. M-O-N-C. All right. Wow. This does look like a pretty good business. All right, hit me up again when it goes to 45 or 40, and we're probably going to be very interested. I just think this has got to fall a little bit more. I'm not sure why, but looks like the margins are holding up. Let me just take a look here. Yeah, this looks like a pretty good business, my friend. Yep. Balance sheet. Yeah, this is pretty nice. So far, I mean, this means like it's worth starting to look at. Yeah, I mean, it's interesting. Yeah, I like it. It's European based, so good job. M-O-N-C. Daniel Hussein, Next Tracker. NXT. All right, it's down 50%. What do they do? Problem with this is there's not going to be enough data for me to go back far enough and feel comfortable. All right, so this is interesting. What the hell do these guys do for business? Solar tracker and software solutions for utility scale solar. Ooh, this is interesting because like I keep looking at green stuff, which did a lot better under Trump than it did under Biden. And I've been looking for one. If you can show me a decent balance sheet, you got my attention, my man. And yeah, I'm getting interested. A lot of share dilution. I'm not loving this at all. So I just want to understand that. I like this. I'm going to take a look at it. I think it's interesting. I'll probably do nothing with it, but nice work, Daniel. Lucas Mueller recently had a look at Samsung SDI. Quite an interesting situation where China dominates 50% of the market supply for batteries. Samsung SDI and some other Korean players seem to be the only insurance for the West if China becomes a warmonger. Blah, blah, blah. Nicely down. Fundamentals don't look that horrible. Government subsidy train interdependence from China. Care to have a look? All right, so we're not going to pull it up there. Samsung SDI. I mean, this thing is just burning cash, like it's going out of style. Yeah, probably a pass on this one. Honestly, if you want to look at South Korea, look at Coupang. I keep looking at it and doing nothing. It's the Amazon of, I got enough Amazons of. I got Amazon of China. I don't need Amazon of Korea. But if I didn't have Amazon of China, I would be looking at Amazon of Korea, which is Coupang. But it's a little rich, but it's also interesting. So for this, I'm going to pass, but good luck. There we go. We got that back. All right. Toma Fisher, thoughts on Match Group. We've covered this a million times. The revenues aren't growing. It's okay. I don't know how young people date anymore. I think this thing is kind of tired and dead. I could be wrong. I think they do Tinder or Hive or something. Look, it's generating a ton of cash. This is okay. Must be why I keep looking at it. So why the hell is Barry Diller not doing anything with this? He's asleep at the wheel. He's just not doing anything. He's checked out after building an incredible business. The guy just took a nap. I gotta learn this business because I keep seeing what you're seeing and I want to get involved, and then I look at the business and I don't get involved. So yeah, all I can say about this is you got to get on like 8 conference calls, start to listen to what have they promised they would do to turn it around and what have they actually delivered on, and why can't this thing, is there some seller? This thing looks great. This thing looks like a China stock. The fundamentals are doing great and the stock won't go up to save its life. So help me understand why. All right, so they had a lot of share issuance. I'm not thrilled about that, but now they've reversed it, so that's good. It might be ready. Cash flow's hanging in there. They're bringing the share count back down after being pigs, and I'm going to look at it like a 50th time and maybe actually do something. So good job on that, Toma. JT Investor. Tom, your media presence seems to have grown significantly over the last few years, and your presentation skills are very impressive. Thank you very much. Can you share some insights on how you refine your presentation skills, things you do to prepare for presentations, and any other tips, lessons learned over the years as you clearly mastered your pitches, have great ability to convey excitement and conviction that is genuine and creates positive engagement with your audience? Any recommendations on books, training, resources would be appreciated. Thank you and keep up the great work. One, thank you. Very grateful for that commentary. Two, I just, if you love what you do, it comes through. This is what I love to do, okay? I love family, I love doing this, and I love playing golf. I haven't played much golf lately, but I did just join the local club. So markets close at 1 p.m. out here, which is pretty awesome. So I'll get that going. And I got to get my goal, by the way, going here to get to a single digit handicap. I don't think I'm going to get it done before the end of the year, but moving in the right direction. It's amazing. There's this golf tech 1 block away from my apartment in New York City. So I take lessons when I'm in the city 10 days a month. And then I can play out here all year round. So I'll get there. What does that have to do with your question? I don't think there's anything you can do other than love what you do and do it 24/7. So you're preparing, yeah, but your preparation is just what you do in the normal course of business every single day. Like, I mean, look at my daily reads. If all you did was read my daily reads every day for a year, you would know more than 90% of the people in the market. And that takes a long time. So, that's 2-3 hours every single morning. Make it look easy. Sometimes I'm doing that from an airport lounge. Sometimes I'm doing it the night before because I got to be up at 5 in the morning or 4:30 now. Now I'm up every morning at 4:30 because I'm on the West Coast. But, they have clubs called Toastmasters. I guess that could help you with public speaking if you're not a good public speaker. I went for like 2 classes one time when I was young. I found it boring and I never went back. So I just love what I do. I mean, if you asked me to speak about nuclear physics and read a book and give a presentation on it, I wouldn't be a good presenter because I'm not interested. So just find something that you love and it will come through and you'll attract a group of people, like-minded people, and live a happy life. David, big fan of your show from the UK. Could you please have a look at Okta? Thanks and happy Christmas. Happy Christmas to you. OKTA. Yeah, a lot of these COVID darlings that have crashed are now getting interested, like PayPal, which, it's moving and grooving. No one's paying attention. Okta might be another one. I have to understand that business, but I've been looking at it. And we'll probably do nothing, but I think that one's going to probably work. Let me just confirm that with the numbers. Yeah, I gotta figure this one out. The key is, it's like, what are you going to sell? What are you going to replace it with? So there are just huge opportunities. Identity partner in the U.S., managed secure identities such as single sign-on, access applications in the cloud, All right, so I just want to understand how they can't get disrupted. And if I can get to that with these numbers, I'm in. But that's where the work begins. And I think that, let's just take a look here. I'm sure the balance sheet is great. Yes, let's talk about cash flow. Great. Why does it have such a low return on invested capital over time? I want to understand that. This is definitely worth a look. So I'm probably not going to do anything with it, but I think you're on the right track, David. Max Moore, ASML. I like monopolies. Yeah, they're hit on China and all this stuff and US and blah, blah, blah. I'd like to see it come down more. I keep looking at this. It's on my watch list, but I'm probably going to miss it. If this, I should put like a alarm at 600, and if it gets to 600, really do some work on it and get involved. But not yet for me. Kyle Johnson, thanks for all the value you provide. You're welcome. I came across the company Janus International Group. Their business is all around installing, maintaining storage unit doors and other systems. Rise rent, commercial real estate, expectations, lower interest rates. This caused the stock to drop 50%. IPO 3 years old. All right, Janus International. Let's take a look. I thought you were going to talk about the asset manager, but that's Janus Henderson. JBI. Man, we got some smart people tuning into this every week. I'm super excited. You guys are learning and earning and contributing and sharing with your friends and family to grow the thing. So cash flow is down, stock's down a lot more. Yeah, so it was a growth story. Now it's not. What are they doing to equity? They're diluting the hell out of people, probably for an acquisition or something else. Nice cash from operations. Free cash flow, okay. Balance sheet. Balance sheet's a little bit levered. Yeah, I think you just got to get comfortable with how are they going to reaccelerate earnings, Kyler, and what the competitive landscape is like. Do some channel checks, find out who they compete with, talk to their competitors, and you'll learn a lot about them. But I think that's worth a look. It's worth doing some work on. Eric Haney, thoughts on tax loss harvesting BABA into something like KWeb. I started buying BABA. Nothing on margin. I'd hold out. I seriously, I think there are too many outs for me. It's an absolute no-brainer. So I wouldn't want to do that personally. So you could do it. I just don't think KWeb's going to do as well as Alibaba, and that should be the case. It's not because there's anything good or bad about KWeb. I think KWeb's fantastic, and I think it's a diversified way. If you haven't done the work on Alibaba to have the same level of conviction that I have, you should own KWeb instead. So that might be the right trade for you. Depends what your tax losses are. If you've averaged down, you'd have to do first in, last out type of thing. But if you've been paying attention, you probably have a basis in the 80s, in which case then you should be just sitting tight and waiting to make a lot of money, in our opinion. Tuhin G, thank you for all you do. Longtime listener, can you please take a look at RPRX Royalty Pharma? Pipeline's worth over $1 billion. Buying back shares. Yeah, these are special situations. And yes, I know you've been listening for a long time. I appreciate that, and I appreciate your support. Tuhin, RPRX. I don't love these. I don't love these royalty plays. I've seen too many through the years. I mean, yeah, I get what you're talking about. Jeez. Yeah, it's just the market never gives them their full intrinsic value. There's always an overhang. That's what bothers me about this. But this reminds me of Vector Group, which was a stub on cigarette companies. Made a ton of money. But the same guy also got bagged in Borders books. Share count, okay. $6 billion of debt on a royalty business, $600 million of cash. $2 billion. Gosh almighty. Yeah, I get it. I get it. You just have to understand all the individual royalties, which is going to take a lot of work, but certainly on the right track to him. I think worth a look. Nice work. Richard Liu, ignore my question on Pags and Stone. You answered it last week. Can I ask you what's your favorite data to look at to see new car sales? I look at Cox Automotive. All right. Christian Bala. Christian Bala. Thank you very much for your weekly insights into the market and showing us U.S. value investors interesting opportunities. What do you think of Polytech Holding, ticker PYT? They manufacture parts for the automobile industry. Okay, PYT. That's not it. Polytech. Polytec. Polytec. Nope. It's not showing up there. So how to get rid of this guy. All right. Don't want that. Don't want that. Control 0. All right, let's see if we can get this going here. And okay, thank God. All right, we got rid of that. PYT. PYT. Okay, Polytech Holding. Plastic solutions for passenger cars and commercial lightweight vehicles. Oil separators. Huh. Financial analysis. Low quality business over time. Let's see what's happening with free cash flow. Okay, balance sheet. Share count. I would say that if I didn't own Cooper Standard, I would look at it more carefully. Yeah, same thing, peak in 2027. I mean, it's basically the same as Cooper Standard. I just like and trust Cooper Standard management more. I know them. And but this is definitely interesting for sure. There's a ton in the auto space that I keep looking at that have tremendous. All right, TJ Vandermeer. Hi, Tom. What's your opinion of GN Store Nord, Danish company specializing in hearing aids and audio devices? Revenue decline. Market leader. Turnaround plan in place. Low price. All right, let's see. GN Store Nord. Okay. Man, this is probably the best AMA we've ever had in 5+ years. That is pretty amazing. Little bit of dilution I don't like, but other than that, looks like a really solid business. I'm interested. Good work. Now you got to just understand what the competition is, why the revenues are declining, and what's happening with share. But all right, here's another car one, GTX. I'm sure it's probably also good. Garrett Motion. Flat revenues. What's happening to... What is going on with the share count? This is weird. These numbers are probably wrong. Yeah, so they've got solvency risk. $1.5 billion of debt, $96 million of cash. So that's what you got to get comfortable with, is the maturities and the business and the competition. But I think there are ways for it to get solved, but it's not a guarantee. Linda Nickerson, wondering about the last video about emerging markets. Which stocks would he recommend? We only own Alibaba directly, and then some indirect plays like Estee Lauder and a tiny position in Goose. Long-time watcher of your show. Like to pitch Swatch Group, Watchmaker, Harry Winston, Omega, blah, blah, blah. Seamaster, no debt, blah, blah, blah. Market cap. Hayek family. I bought another 35 million. All right, well, interesting. SWATCH. Negative free cash flow. So yeah, look, they're just turning negative free cash flow. You have to understand the turnaround plan. I don't think there's a lot more to talk about here. Right now, it's a no touch until I can understand the turnaround plan, but definitely keep it on the radar. Jimmy Jones, could you decide if a stock is dead money or an opportunity cost, even if fundamentals are still the same when you move on that situation? We've covered this in the past. We apply the same framework. Some go super fast, some go super slow, but they all work when you buy good quality businesses below intrinsic value and you take solvency risk, you rule out solvency risk off the table. Good things happen when you buy quality assets when they're on sale. That dead money bullshit, that's just trader bullshit, because they're impatient, and the stock market is a device for transferring money from the impatient to the patient. I prefer to be part of the latter and not the former, the transferee rather than the transferer. And people who talk in these terms are always the transferers versus the transferees of the wealth, because they are impatient and they fall into that. It's a trap, it's this and that. But if you apply a good framework across 8, 10, 12 great companies, you're going to do great over time. And don't get faked out by the shiny object and the people who think it has to go super fast. And you'll be fine. Any advice worth investing in? Ranpak? PACK. Turning cash flow positive. What do these guys do? You know, there are a lot of these COVID companies. Product solutions, end-of-line solutions for e-commerce, packaging solutions, blah, blah, blah. Yeah, it looks like it's trying to recover here. How's the business doing? Revenues are starting to recover, it seems like. Management is a tad piggy with equity. Don't like. Me no like. Kind of lower quality business over time. Cash versus debt. Little bit levered here. This is what you got to worry about and keep your eye on. Yeah, that's going to be your big thing. If you can get comfortable with solvency risk, your recovery is probably okay. So not bad there. Monique. And let's see here. And then finally, Landon H. Looking at Bear as a long, completed partially settled roundup litigation, still has some settlement items outstanding. A lot of debt. Once market clarity on the remaining litigation, pay down after debt. How would you evaluate this stock? I wouldn't. We've looked at it a million times on the podcast, and we've always passed. I don't really like this one. I had confidence in 3M, which is why that worked great. But we also didn't stay too long at the table because if you remember, we had this spike up and now it's back down. So, we got out and then it shot up to 140 beyond us. Now it's all the way back down to 129. I think this one will actually be okay, but it was such a large move in a short period of time and you still had some uncertainty and, every now and then you got to book profits. So, let's take a look here. BAYER. Why is it not giving me the correct one? Yeah, I just don't have. Look, I think you're going to be right, but you're basically playing roulette, black and red. Is the litigation over or isn't the litigation over? And I really don't want to play that game. I could play it with 3M because I understood the rest of the business and I understood I could quantify and I had an estimate range. This one, I don't know. I think it's probably worth a gamble. You put 1%, 1% of your portfolio, maybe you have a 3x, 4x. But I don't think you can have any edge on it. And for that reason, I'm out. With that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. We'll be in New York the first 3 days of the week for some in-studio stuff. We're on Varney tomorrow morning early, remote. And in the meantime, make it a great one. Bye for now.